I think there's enough new buying coming into the market to absorb any of that selling. I think the main reason that you saw the big drop in March following the outbreak of the war was that gold had risen rather substantially in the preceding 2 months. I mean, a tremendous rally, really from 4,000 to 5,500 in a few weeks. And part of that rally was anticipation of war with Iran, because they were really, waving the sabers around, for several weeks before we started the war. So it didn't come completely out of left field. Right? Our troops were moving around, our ships were, the presence was there. So gold started to rise, or rose in part because people were worried about a war with Iran. So when the war finally happened, people took profits, buy the rumor, sell on the news, and that's what happened. But gold's around $4,800 an ounce. I mean, that's a pretty good price from where it was a couple of years ago. And I think the trend is up. I think gold's going to finish the year above 6,000. I don't think that the bull market is close to ending. Yes, some countries may need to sell some of their gold. That's what the reserve is for, to tap into when you need it. But more countries are going to be looking to build up their reserves. I think the central banks that have been buying gold, a lot of them are going to buy more. And I think the central banks that weren't buying gold are going to start buying it. And I also think a lot of private investors who haven't been buying gold are going to be buying it. Institutional investors, retail investors. I think the demand is just going to go way up, and that's going to overwhelm the supply. I am not telling people that you should buy gold stocks because I think gold's going to be, $40,000 an ounce in 5 years. But it's not impossible for that to be the case. It would depend on what happens during those 5 years. If we have a real sovereign debt crisis, like former Secretary of the Treasury, Hank Paulson, warned about last week, he said that we need an emergency break the glass kind of plan to deal with a sudden loss of demand for treasuries. He didn't tell the Trump administration, why don't you do something now to preempt that crisis? Why don't you try to shore up our finances, cut government spending, do something so that, foreigners won't lose interest in treasuries? No, his advice was, it's going to happen. Let's just have an emergency plan to deal with it. And so if it does happen, and obviously whatever emergency plan we have ain't going to do anything, on my own podcast, what I was saying was the emergency plan should be, a revolver behind glass, and then you break the glass and shoot yourself in the head, because there's really not much you could do once the crisis hits. But if we get a crisis like that and the dollar tanks, I've had a long-term forecast for the Dow, right? The Dow has been falling for 26 years. It's gone down by 75%. It's gone from over 40 ounces of gold to under 10, right? Over a 25, 26-year period. My ultimate forecast is for a bottom somewhere between 1 and 2, where the Dow is worth somewhere between 1 and 2 ounces of gold. Now, in order for that to happen, with the Dow at 50,000, the price of gold would have to be somewhere between 25 and 50,000 for that to happen. Now, so if that happened within that 5 years, it could happen. Now, it could also happen with the Dow going back to 10,000 and gold just doubling, and now you're at 1 to 1. In fact, if the Dow goes to 20,000 and gold goes to 10,000, you're 2 to 1 there. I mean, and so that's not that big of a stretch that could happen. But yeah, I mean, I try to hey, gold's going to go to 10,000, whatever. That's a big enough move. But yeah, all this stuff could happen. And if it does happen in 5 years, I'm going to be a very rich man. So, because I have a lot of gold mining stocks. That's my biggest position. Gold and silver mining stocks. I also have the metal, but I have a much bigger position in the miners. And if gold is at 30,000 in 5 years, which would be a 6-fold increase from where it is now, I would imagine the miners will be at least 20x what they are today. So that's big for me. I mean, and I have positions in everything, like kind of across the board. You look at my gold fund that, Adrian Day manages it for me, Europe Pacific Gold Fund. EPGXF is the no low symbol. You can get the prospectus and more information on the Europac website, europac.com. But about a third of our portfolio is junior miners, which includes some exploration companies. A couple of them just got bought out in the last few weeks. So that's part of why we own them. We think there's going to be a lot of consolidation. We have a big position in the royalty companies too, because it kind of balances out all these little juniors. That's the least risky part of the spectrum, because a royalty company isn't taking all the cost risk, just taking a royalty off the top, right? Just what the price is. And then, of course, we also own the senior producers and the mid-tier producers. So, you get a good cross-section of stocks when you buy into our fund. What you don't get is mindless indexing. I have a guy who's been doing this for 40 years, deliberately trying to pick the stocks that he thinks will do the best and avoid the ones that he thinks will do the worst. And I think his judgment is adding value. I don't believe in the efficient market in that you can't try to beat it, that all the information is there. It's not, because not all the analysts are the same. Some people could be wrong. And so prices reflect a confluence of opinion, many of which can be wrong, but it shows you what the consensus is at any moment in time. Well, the demand destruction that stems from rising oil prices is not just in oil. In fact, I don't even think it's mainly in oil, because people need energy. You need to, go from point A to point B. Stuff needs to get delivered. People need to, power their houses, heat them, cool them. And a lot of these, the fertilizers, we need, the farmers need that stuff. Yes, if gas is expensive enough, I can cut back. I don't have to take that vacation. I can carpool with my neighbor. So there is a way to reduce your energy consumption, but you can't just turn it off completely. Right? You still need energy. But what I can turn off completely is other items that I used to buy, but I now can't afford them because everything related to energy costs me more. So that's where the demand destruction is in the discretionary items that I give up entirely so I can keep buying energy, so I can keep the lights on and keep driving back and forth to work, right? So that's going to be the problem. And that's why rising oil prices, they're not inflationary, they're recessionary. What's inflationary is how a central bank responds to that. So if rising oil prices cause recession and then central banks print a lot of money and cut rates, that's what causes the inflation. Now that causes all the prices to go up, not just the energy prices and energy-related prices. Well, no, I mean, inflation by definition is an expansion of the money supply and credit. That's what it is. Prices go up in response to inflation. They don't cause inflation, or they are not inflation by definition. So the public doesn't know what inflation is. But, the public expects prices to go up, and they're right. Prices are going to go up. They'll probably go up by more than what they expect. I think they normally are wrong on the low side. And contrary to what a lot of economists say, including economists on the Fed, expectations are not what causes prices to go up. It's not like the field of dreams, right? If you build it, they will come. If you expect higher inflation, you will get higher inflation. No. It's if the Fed creates more inflation, you're going to get more inflation, regardless of what the public expects. And so I think that there's a lot more inflation in the pipeline than what the public expects. They're going to be surprised by how much inflation we get. Yeah, I think reversing exposure to kind of cyclical stocks might make sense, but not to the raw materials. I think that those materials are going to continue to be in higher demand, especially with what's going on with AI. You really generate more demand for the resources that make the whole thing work. So no, I mean, I own a lot. In fact, I just recently bought more a copper stock myself the other day. I mean, I want to own these metals, even though I have a bearish outlook on the economy. And you mentioned that the Fed is not cutting rates, which is true. but they're also not hiking rates, which they should be doing. Because if you look at what's happened to inflation over the past several years, I mean, not years, over the past several months, it's clear that inflation is going to be quite a bit higher than what the Fed had expected. Looking at money supply growth, look at the balance sheet growth. And then the Fed likes to look at the CPI and PPI. Well, look at these numbers. They're jumping up. Energy is a big part of that, But even if you just look at the core, you're still seeing prices rising at double the Fed's 2% target. So the Fed should be hiking rates. They're not hiking rates. And so that is problematic, that they're not hiking rates when they should be. And I think that's why people need to get out of dollars and out of treasuries, and people should be buying gold.